Good afternoon, everyone. This is Chelsea Cruz from the Federal Reserve Bank of New York. I think Adrian Franco is waiting to connect, but speakers, can you hear me? Great. So without further ado, and thank you everyone for your patience, I'm just going to turn it over to David Erickson to start. David, over to you.
Thanks, Chelsea, and our apologies to everyone. This is, challenges in this time with technology. We did practice this and it worked perfectly, so it's very frustrating. I just want to let you know that this is part of a series of outreach efforts that we have done with the Community Development Outreach Group at the Federal Reserve Bank of New York. And we realized quickly after dozens of these that we are not getting enough voices and we are not reaching enough people. So that's why we went to this web platform in order to bring more voices into this conversation. Just to let you know, this is going to be a very compressed schedule and we are running a little bit behind. So we are not going to be able to take questions, but we are going to be sending a survey out to you after this where we're asking you to give us your impressions, your observations, your opinions, and we're going to take that and put it together with the comments of the presenters here today to put that into a document that's going to inform us going forward. So just want you to know we do want your feedback and we'll be collecting that through the survey after this event is over. We have a limit of 1,000 people that can participate in this event that we usually don't get 1,000 people, so we didn't think it was much of a big deal, but within 36 hours of announcing this, we were well beyond the 1,000 number. So there clearly is a hunger for people to be heard, and we want you to know that we are listening to you. And what we are hearing will not come as a surprise to anyone on this call, is that there is a problem for nonprofits and very small businesses accessing the pandemic relief programs, and we are trying our best to make sure we can find ways in which we can streamline that effort and find ways to make it more effective. And that really is the goal of this conversation today. We are going to have three separate panels that we're going to tackle this from different areas. The first panel will look at the problem that I just mentioned from the perspective of very small businesses, nonprofits, and the financial well-being and security of low-income households. The second panel is going to focus on promising channels in which we can provide capital to those organizations that are dealing with that problem. So to that end, we will hear from a representative of community development financial institutions, CDFIs, philanthropy, and a community-oriented bank. And then finally, we are going to hear from some representatives from the Federal Reserve on what is the Fed doing to help ease the flow of capital into the places where it's needed most. And I just say, it's just a personal note, I'm the most junior person on a kind of a senior leadership call that happens every morning at the Federal Reserve. And when we go around for the markets division, bank supervision, economic research, and other parts of the bank, there is an anguish among those groups that there is a worry that we are creating unintended consequences and negative effects on vulnerable people. And so we just want to make it explicitly clear that at the very highest levels, people are paying attention to those needs. We are cognizant of the mistakes of the past. We do not want to repeat that and accentuate inequality. And we're doing our best to make sure that the responses to this crisis are as fair and equitable as possible. So thank you again for joining us. We look forward to hearing from you through that survey. And I'll now pass it back to you, Chelsea.
Thank you, David. And I think Adrian Franco is now on with full audio. Adrian?
Hi, everyone, and apologies, as David says, technology. But thank you again for joining us. And before we continue our agenda, I just want to note a couple of housekeeping items. Number one, this is on the record. Everything that the speakers will say is on the record. Second is that our video will be uploaded in our website very soon, hopefully within a couple of days. I encourage you to share that with your network, with your organization. And third, you will receive a survey just after the webinar. It's very important for us that you fill that survey with your opinions, your views, We are listening as the Federal Reserve, as the New York Fed. We're constantly listening to you. So that information is very important, and we appreciate if you will fill in that survey. We are not taking questions live because of the format, because the amount of people who has joined. As David said, we are very, very happy that we have such a demand for this. We are waiting to connect with the President and CEO of the Federal Reserve Bank of New York. I believe that that's still, we're still waiting for that to happen. We are troubleshooting exactly what happened with his link, and hopefully that will happen within a few minutes. But I don't want to delay more the conversation. So what I suggest is that we transition to session 1, where we're going to hear from leaders in the community development space about what they're observing in the community. So back to you, Chelsea.
Of course. So thank you, everyone, again, for your patience. Without further ado, we're going to start session 1, which is going to focus on the impact of COVID-19 on underserved communities and the current funding gaps. We'll hear from Joe Neary, CEO of IFS, Judy Kendi, Vice President and New York Market Leader of Enterprise Community Partners, and Jonathan Mintz, Founding President and CEO, Cities for Financial Empowerment Fund. So Joe, over to you.
So good afternoon, everybody, and thank you so much for the invitation to speak. So as Chelsea said, Joe Neary, I'm the Chief Executive Officer of IFF, which is a large, diversified CDFI serving 10 states in the greater Midwest, with offices in 7 cities, including Chicago and Detroit, 2 highly impacted cities vis-a-vis COVID. We are focused on nonprofits of all types serving low-income communities. I'm also actually the former chair and current board member of Acción Chicago, which is a micro lender focused on minority and women-owned businesses. So to start, I'm very cognizant of commenting on the efficacy of a program, or the Paycheck protection program, that is literally a month old. And of course, when you see over $350 billion gone in a couple weeks, you get a whole new sense of fast, right? And I'm very cognizant, like all of the speakers are going to be, that that we're working with rules and regulations and anecdotes and stories on a program that literally are changing hourly, daily sometimes. And obviously, Congress is working on a new addition to that package with some set-asides for CDFIs, which I'm sure Lisa will be talking about in a second. But with that said, I don't think it's surprising that a program centered around quickly dispersing support through the traditional banking system and using the SBA platform was not going to be greatly skewed away from the smallest and most fragile businesses and nonprofits, low-income and communities of color. So I kind of wanted to segment my comments into kind of 2 buckets. So kind of what is happening right now and why, but also why we really have to interrupt it. For IFF and Acción, we immediately saw that the 3P program was going to hit the unbanked, or not hit the unbanked, I should say. Those businesses and entrepreneurs approaching a bank for the first time, literally the smallest, the most fragile businesses are basically not participating, or they're just locked out. And if you think about it, it's very difficult to use a system that you have not been a part of. So I don't think that there's any surprises here that really for the unbanked, this is going to be a Herculean lift to somehow break into the program. But I also want to talk a little bit about, I think, kind of what we think about as the underbanked. And generally nonprofits in our space have banks. But when I say underbanked in this context, it's those at very small banks, very local banks in rural areas, and many banks and of those sizes are not necessarily participating in the 3P program, but many of the agencies and the smallest businesses have just checking or savings account relationships with their bank. And so we are seeing many of those agencies or smaller micro businesses kind of being turned down immediately because they're at the wrong bank or are just a really small customer at a larger bank. And so those that have been turned down in the traditional space are now going to larger banks for the first time, and again, they're not customers, so you can imagine where that's gone. I think on the bank side of this equation, right, I don't think it's surprising that most traditional banks already started making decisions about how they would participate in this very brand new program with few defined rules and regulations, right? So I'm actually fairly sympathetic to many of the traditional bankers who are also trying to act in this very fast-moving environment and make decisions about how they will serve. And of course, they're going to start with their customers and their deepest and largest customers. I don't think it would surprise any of us that that's going to be the case. So as they're making those decisions in real time and trying to figure out how they're going to make money, I don't think it's surprising to any of us that they're looking for the oldest customers, the deepest relationships, and that they're focused on the biggest loans and the ones that are going to need the least amount of technical assistance so that they can maximize how much money they might make and control how many expenses they would have. None of these things are surprising, and so I think very quickly you can see a common sense filtering system for decision making in taking P3 applications. Start with your best customers, then your biggest customers with the biggest loans, the most sophisticated customers, and poof, the money's gone. And so that decision tree is inversely incented away from IFFs and most and the average CDFI, Community Development Financial Institutions, average customers, right? I don't think that there's any surprises there. That is not to say that IFF's customers, many of them have not have been served, but we certainly are seeing many have been turned away, and because of the rapidity of this program, it is not surprising that many haven't even got to that place where they've even figured out how to maneuver through the system. So if we think about the bell-shaped curve of, business evolution, right, from the startup to the long generational businesses, it's the newer businesses that are going to be the most threatened because they're going to be the unbanked or the underbanked and have the least long relationships, which will then put them further and further behind in terms of applying for these loans. And I think, of course, if you unpack that list, what you're going to find is that that is very much skewed against businesses and nonprofits owned by people of color or led by people of color who are more represented, not solely, but more represented in the early stages of the business continuum, and the least likely to be the traditional bank customer that I just talked about is kind of being shut out, and then therefore the most threatened with extinction, because we start to think about the existential pieces of this virus and its effect on our communities. So, for us at IFF, we see the program intervention, the P3 program intervention as the exact embodiment of structural racism, right? We're using a banking system that has not traditionally served communities of color particularly well, with a very time-sensitive program. And it's a system that's going to make logical decisions that are not based on race, because that's, of course, illegal, but very much based on sound business practices of taking care of your traditional generational customers that are the largest and most sophisticated, which, of course, is proportionally skewed away from communities of color. And obviously, those are the most fragile businesses most likely to be impacted by this crisis and not survive. And I think that when we start unpacking that, then, of course, we look forward 5 to 7 years from now when things get back to normal, whatever that means, right? And, the financial system analysts will start to note that, the business continuum has disproportionately higher percentage of businesses of color in the earliest stages of business, because those that will move on and create themselves from anew will also put us right back on that continuum of being skewed there. And this is the embodiment of structural racism. So for us at IFF, we've been so passionate about interrupting this cycle that even though we are a long-term facilities lender, we have jumped in to take on the 3P program and are really focused on serving nonprofits that have been turned down or are finding any difficulties with the traditional banking system in terms of applying as a way of trying to interrupt this cycle. So thank you very much.
Thank you so much, Joe. Over to you, Judy Kendi, Enterprise Community Partners.
Thank you. Hi, everyone. Really appreciate the Fed hosting this forum, and to all of you for joining. I'd like to start by saying what we've all seen, which is that the pandemic has visibly exposed the massive racial inequities in the United States and made clear that to create a just society, everyone must have a home that is safe, healthy, and connected to good jobs, schools, and healthcare. To recover from the pandemic and put us on a road to this housing vision, we need 4 things. We need rental subsidy and support for homeowners, as the eviction moratorium put forward by New York and other states and forbearance are important to delay the problem, but they aren't a solution. We need new affordable housing production as part of the infrastructure plan. We need to support the CDCs and CBOs, who are the backbone of their communities and serve on the front line in any crisis, including COVID. And we need federal support for states and cities as they lose tax revenue, particularly property tax, which drives the budget for cities. To go into more detail, for the rental subsidy, we need a comprehensive federal rental assistance plan, and the need is vast. Pre-COVID, only 1 in 5 people who needed Section 8 received it. We also need $48 billion in federal home funding for localities to create their own rental subsidy to cover rental arrears and meet the needs of landlords, such as cleaning and operating costs. We also need money like this for local programs to support those excluded from federal packages, including undocumented residents. In terms of home ownership, the economic impact of COVID-19 has put low to moderate income homeowners at risk of losing their home. Mortgage relief in the CARES Act is inadequate and only applies to federally backed mortgages, excluding 14.6 million homeowners. Therefore, we must establish a federal loan modification program at the end of the COVID forbearance. We need to complement this effort by $700 million in funding for housing counseling, which was proposed by Representative Maxine Waters in the 4th stimulus package. Second, we need housing production and preservation as part of the infrastructure bill to spur recovery and meet demand. The infrastructure bill should include affordable housing and public housing. We should also be creating funds to preempt predatory equity purchases of distressed real estate to avoid what happened in 2008. Finally, for existing housing tax credit deals, we need legislation to modify deadlines due to COVID delays. And if you're interested in more details, the Action Campaign, which my organization Enterprise co-chairs, has comprehensive recommendations. Third, we need support for nonprofit landlords and service providers, the backbone of their communities and critical to crisis response. This is going to require a public and private equity, including $40 million of Section 4, a HUD capacity building program, and philanthropically funded initiatives like the Emergency Action for Residents and Partner Sustainability Fund that Enterprise is spearheading. And finally, we need sufficient federal support for cities and states. Cities and states are going to have to make very hard choices about what to cut because tax revenue is being decimated at a time that government is being asked to do more. The care packages to date have been inadequate, and looking to the 4th and future care packages, it will be for COVID response, but not to make up budget shortfalls. So recovery is going to be long. We learned this after 9/11, we learned it after Sandy, but we've gotten through it before as New Yorkers and we will again. The imperative here is to make sure we have an equitable recovery from COVID-19. Thanks.
Thank you so much, Judy. And over to you, Jonathan Mintz, Cities for Financial Empowerment.
Good afternoon, everybody. I'm really happy to be here. I'm happy to share what we are seeing at the Cities for Financial Empowerment Fund through our partners on the ground. Hopefully, this will help all of us think about the best way to direct our organizational resources. Just as a tiny background, the Cfe Fund focuses on family and individual financial stability. We support about 80 cities and counties around the country by funding and enhanced technical systems to build out financial empowerment programs as public services. So we are focused right now, and our partners are focused from this perspective on 3 COVID-specific priorities. And I want to tell you briefly what those are, what we're learning from our partners, a little bit about what we're doing. Those 3 priority programs are, number 1, fraud and scams against consumers. Number 2, unbanked individuals and the impact of being unbanked on receiving and using stimulus dollars. And 3, financial counseling generally, and also navigating emergency benefit resources more specifically. So first, frauds and scams against consumers. Unfortunately, it's probably no surprise that with crisis begets scam. And we are seeing scams crop up against individuals in 2 ways. Virus mitigation scams and stimulus money fraud. For virus mitigation, we're seeing scam products and services that are being sold that promise to either physically cure the virus or limit its impact or to somehow protect one's apartment or home. On stimulus money fraud, what we're seeing is so-called anticipation-type loans, payday-type loans against these stimulus dollars, and we're also hearing about criminal activity online fraudulently claiming other people's stimulus through the IRS portal. What we're doing is we're equipping our city partners, many of whom have helped, we've helped launch local departments of consumer affairs like they have in New York, in order to share strategies with each other, to leverage consumer outreach platforms and also leverage the voices of the mayor in those cities to be able to send out strong signals and also to deploy strong legal opportunities to go after some of these frauds. One example, and we've seen it here in New York, sort of a side note around scams here can be in price gouging. Price gouging is complicated legally. Generally speaking, people can charge what they want to charge, but cities are increasingly employing laws that are putting ceilings on what price increases could be for certain emergency items. The second topic that we're hearing a lot about and paying a lot of attention to is unbanked individuals. For tens of millions of U.S. residents who don't have bank accounts, these stimulus payments were not directly deposited this week. They are in a long queue to get paper checks, some of whom are going to have to wait until August or September. There are 3 problems there to keep in mind. Number 1, the obvious one is a delay. Waiting that long is, absolutely counterintuitive to the point of an emergency stimulus. Second, the cost and hassle factor. Remember, once people finally do get these checks, they have to cash them. They have to pay those fees. They have to go to the place to be able to cash those checks. And then they have to pay for and deal with converting what they've cashed the checks into the instruments with which they will be paying their bills. The third factor to keep in mind, and particularly now, is safety and health. Walking around with a large amount of cash is never a particularly safe thing to do, but in addition, this process of going to get your check cashed and then figuring out how to put together instruments to spend it violates the strictures around social distancing. So people will literally be putting themselves in physical jeopardy as a result of getting these checks. We are doing 4 things in this regard. I'll just go over them super briefly. One is, many of you may know, we run a national Bank On program. Bank On has certified accounts that are safe and fully transactional. 10 of the many accounts, the dozens and dozens of accounts that are certified by us, 10 of them can be opened online. If you go to covidbanking/joinbankon.org, you'll see that list of 10. And so we are promulgating as much outreach as possible. The second thing we're doing is we've been working with the FDIC and the IRS in order to guide Americans who are going to the IRS portal looking to figure out how they can get their checks faster directly to these 10 safe online openable accounts. And so we're really appreciative, actually, of the FDIC and the IRS's cooperation there. Third, we're activating and equipping the 90-some-odd coalitions that we support around the country to get the word out through their local delivery channels. And fourth, we are putting together large-scale consumer awareness strategies that people don't have to just wait for and then suffer through these checks. They can open an account online, plug that account number into the IRS portal, and get direct deposit. The last thing I want to say is I want to talk a little bit about financial counseling and navigating emergency benefits. We run financial empowerment centers, as many of you know, around the country with one-on-one remote counseling. We've obviously helped pivot all of those services to be appropriately done online at high quality, and mayors are pushing forward these high-quality financial counseling services as part of their frontline emergencies. Here's what we are getting reports from our counselors. Overwhelmingly and not surprisingly, we are hearing about job loss, and in particular, disproportionately so for people of color. Other priority pain points are student loan abeyance opportunities. They exist, but people are confused about them and how to access them. Credit card bill stress, of course, healthcare issues, and housing. The last thing, of course, is our counselors are also hearing people having trouble navigating the IRS portal, and they are trying to help them with that. I'll stop there, and thank you all for your attention.
Thank you, Jonathan, and thank you to all of our speakers from session 1. We're going to move right along and transition to session 2, which will focus on the role of socially responsible capital providers in addressing funding gaps and ensuring an equitable recovery. And this will include Lisa Mensah, President and CEO, Opportunity Finance Network, Tina Wright, President and CEO, United Way of New York City, and Anna Fink, Executive Director, Amalgamated Foundation. So I'll turn it over to you, Lisa, to start. Thank you.
Thanks, everyone, and a pleasure to be here and a pleasure to be with so many wonderful colleagues and so many from our community development financial institution sector. I want to speak about 3 things today. I want to speak about this sector of CDFIs and what we really need to keep moving. And I want to speak directly to some of the ways we think we can fit in the Federal Reserve's programs. And I have 2 ideas on there. So first, although you've had wonderful people speak already about our field, I want to suggest that CDFIs have leaned in as some of the financial first responders to this COVID-19 crisis. We are, in effect, the pipes to flow capital, and pipes that were made to flow capital into low-income communities, and as Joe has said, to minority communities, to women, to native areas, to deep rural areas of persistent poverty. And we've been an industry around for over 30 years, some over 40 years. So we feel that we are made for this moment. But our need is for real new resources to keep fighting. And this begins with the most powerful kind of money, which is equity. Our principal need at this moment, and it is our largest advocacy campaign to the government, is for an emergency $1 billion appropriation to the CDFI fund at Treasury. We feel we need this infusion of capital, both to shore up the kind of funds that are here, to be prepared for future modifications and write-off, and to leverage for the future kind of lending that we will do. We want to be here not only in this crisis, but to be the first ones who will start relending, who will lend to startups, who will help people regroup. Remember, every dollar of the CDFI funds is leveraged at least 12 times by banks and other lenders. So a $1 billion appropriation that can go by formula to the eligible 1,000 CDFIs that are out there can be an additional $12 billion of capital that can be deployed in this crisis and beyond. So our first and largest need is equity capital. And our biggest recommendation for that is to join us in the fight to have the future responses to COVID include CDFIs, include these pipes. Second, our second recommendation is to have access to the Federal Reserve's Paycheck Protection Liquidity Facility. As of last Thursday when this opened up, none of the non-depositories could participate. So again, we're leaving these CDFIs outside of the tool that's been established to provide more liquidity. So we're thankful for the Fed stepping in and providing liquidity to the financial system. But the pipes that are trusted for the communities that can move this are ineligible. We cannot be included in that right now. And so we urge the Fed to move on admitting us to be allowed lenders into or allowed to be into the PPP liquidity facility at the Fed. The third idea that we have is to move to create a special purpose vehicle. The Federal Reserve has such a broad range of tools, but none are available right now to purchase loans off of the balance sheets of CDFIs. And we think this would be so important, particularly in those loans that are under $100,000, which are going to be so important not only in this crisis, but moving forward. Opportunity Finance has partnered with the Aspen Institute, with the Financial Access Initiative, and with Resolve to propose the creation of a special purpose vehicle to allow this kind of purchase. And we think it should be focused toward the micro and small business loans. We know this is a new, bold idea, but to us, this is exactly what the country needs so that we can infuse liquidity into our field. This is not a new field. It is an old and trusted field. And we need to have these kind of permanent tools. And I think the Fed could do this under its existing authority in partnership with Treasury. And so we really urge you to consider this. And we think the impact would be immediate. We think that there are up to 20,000 businesses which would immediately be supported through this kind of sale to a special purpose vehicle. So in conclusion, and I want to keep moving us forward, really remember that we're the pipes that are really important for this moment. But in order for us to function as the right pipes, we need the kind of additional support. This is going to allow us to reach deep into rural areas of persistent poverty, deep into Native communities, into those deep corners of urban America, which are not well served by the mainstream. That is why we were created. We need additional grant capital from the CDFI Fund. We need access to the existing PPP lending facilities at the Federal Reserve, and we urge the creation of a special purpose vehicle. This has been actually a good moment. The fact that I'm sitting on this call featured with so many talented people shows the fact that the country has looked to us to do our job, and we look forward to doing this. This is a field of a lot of courage. Nobody's running away. We're running toward this crisis, and we want to be equipped to do so. So thank you for a moment to comment on the essential liquidity that's needed for us to continue to do our job. And I'll yield my time to the next folks on this web call.
Thank you, Lisa. Sheena Wright, United Way of New York City.
Thank you so much. And I too am certainly glad to be in the number here with having these important discussions. United Way of New York City is a part of a network of about 1,600 United Ways across the country. And we are focused singularly here at the United Way of New York City on self-sufficiency for low-income New Yorkers. We define it, we measure it, and all of our work is really focused on economic mobility of low-income New Yorkers. We work at the intersection of 600 community-based organizations in every neighborhood and community in the city of New York, as well as 103 corporate partners and the largest government agencies at the city and the state level. And our job is really to be a backbone in networks that are solving problems that are focused on economic mobility to get to self-sufficiency. When I think about the role that socially responsible capital providers need to play in this moment as we're moving forward, I definitely want to just kind of put out some data points very crisply. I'm sure we're aware of generally, but just to focus in on. Right before COVID-19 hit, 40% of New Yorkers were below self-sufficiency. They did not earn enough money to make ends meet. Obviously, we've just had about another 1.2 million New Yorkers who've lost their jobs. 64% of those job losses have been for people who make less than $40,000 a year. So, there's a focused impact here. And 68% of people who have lost their jobs have been people of color. When we look at the percentage of people who are, certainly falling victim from a health perspective or frontline workers, race and gender play a significant role. I think another data point to appreciate is before COVID-19, 40% of nonprofits in the city of New York had no working capital, none. And the other 60% probably had a month or two, mostly, but were not well capitalized, certainly to meet their current work, but certainly at this moment, when demand for their services are through the roof in terms of the overwhelming new number of people in need of services that nonprofits provide, and capital is shrinking in all the ways that we know. So with that as a background, I think appreciating, for me, the role that social responsible capital needs to play, that there's some overarching themes. Obviously, it's not business as usual. I appreciate Joe's comments at the top where, we are not surprised about how the financial sector responded to the PPP opportunity, but the old models that, of trickle down or rising tides, they're not going to lift all boats. We know that. We know that old models of redlining communities to contain economic challenge don't work. And what we also know is that we absolutely need to be explicit about race and gender, and really the role of socially responsible capital has to be really executed through a racial equity lens. That is really, really, really important. And just again, what Joe said at the top of this is structural racism is not going to serve us well as we move forward. We will fail if we kind of fall back on those traditional models. So I think socially responsible capital has to be three things. It has to be strategic, it has to be sufficient, and it has to be innovative. And in being strategic, again, being explicit about race and gender in the investment decisions. So we can't have kind of a universality or generalization about the outcomes that we're going to have to achieve. We have to be very specific about what we're trying to achieve in terms of investments and outcomes as it relates to Black people, Latinx people, Southeast Asian people. We have to be very, very specific and really name who we're trying to help and to what end. I think that's going to be really important, because if we don't, we will certainly end up in a very challenged state. And just to give a couple of examples, when I think about just the testing for COVID-19 that's happening, we absolutely knew where the communities were that had the worst underlying conditions. We knew by race and community and neighborhood, but we still do not have testing sites in Harlem and in Brooklyn. They're just coming this week, and we are way down the road here. And that's going to have a negative impact for everyone. So appreciating that. What we also knew is before COVID-19 that in the city of New York, only 2% of businesses were Black owned, 2%. So as we go forward, we really have to be focused again and have a racial equity lens in terms of how we're making investments and what the outcomes need to be. The second is sufficient. When we think about the nonprofit sector, we have to very much and very deeply appreciate the role that nonprofits play. Nonprofits are contributing to making sure we have an educated workforce. They're contributing to healthcare outcomes, criminal justice, housing, commercial development, all of these things, but are never really kind of recognized from a capital investment lens for the kinds of things that they drive and really contribute to in a significant way. I think that, so when we think about nonprofits as well, we also don't make investments in nonprofits for their financial stability as an institution. So that statistic I talked a little bit earlier about 40% of nonprofits not having working capital. Funders, whether they are philanthropic funders, whether they're government, do not pay the full cost of services that nonprofits provide and leave them in a very, very precarious position. So going forward, socially responsible capital providers need to invest in the institutions themselves and make sure that they are healthy financially. Nonprofit does not mean that you should have an operating deficit or just, break even. Nonprofit just means tax exempt, and we do want to have financially strong organizations and make sure that nonprofit workforce is also paid appropriately. And then the third is that the socially responsible capital needs to be innovative. We obviously need new models, and I think that we've gotten some examples of those, but certainly for the nonprofit sector, just grants and philanthropy, government contracts, we need other models as well. We need to access the capital markets in different ways, appreciating the impact and the influence that we have on the capital markets. And we need to really co-create what those innovative financial tools and models need to be. Cannot be done by, experts that, went to wonderful educational institutions and have a wealth of experience, but are not representative of the people that we're trying to serve, and are not really a full, diverse, and inclusive base of people to really get in the room and solve some of the problems. So those are some of the things that I think we face. I think we've got a lot of certainly talent and expertise in the nonprofit sector to contribute to that future. And I think if we have those things in focus, we'll make progress.
Thank you so much, Sheena. Anna Fink, Amalgamated Foundation, over to you to close out our session 2.
Great. Thank you so much, and thanks for having me today. I am just feeling so fired up by the powerful clarity of thought and alignment that I'm hearing on this call, and that really connects to my thoughts and the work that Amalgamated is taking on in this moment as well. As we sort of see the impact and magnitude of this pandemic continuing to unfold, it's left many of us in the financial and philanthropic sectors sort of scrambling to meet the need before us. And yet, I think it also really gives us a moment to re-examine the resiliency of our systems, services, and movements. For Amalgamated, as a bank founded by immigrant workers nearly 100 years ago, it's created an opportunity for us to really lean into this legacy and the commitment that we have to serving working people and their institutions and communities. We see it as an all-hands-on-deck moment, and one that is likely to massively redefine life for working people and underserved communities in this country and globally. We're already seeing, as many of the panelists have outlined, that the CARES Act money is simply not going to be enough to meet the demand, and that the persistent inequities of race and class are being reinforced through the first-come, first-served system. For us, that means many of our own clients at Amalgamated who are on the front lines in this moment, including social service providers, community-based organizations, not to mention unions who are left out altogether, will be lucky to get any relief. And certainly one important response is for us to lean into this using our institutional, corporate, and philanthropic leadership voices. And we also saw it as an opportunity in this moment to work and build on relationships we have in the philanthropic sector, and with partners including the Ford Foundation, Open Society Foundation, and JPB, among others. We established the Families and Workers Fund, which we announced last week to bring together capital across institutional philanthropy, individuals, and corporate partners to focus on 2 key priority areas in terms of moving, rapidly moving philanthropic resources out. The first area that we're focused on is getting direct relief to families and workers who are navigating this acute phase of the crisis and building an economy and an economic recovery that is uplifting. And number 2 is supporting organizations to ensure that additional rounds of relief will be as broadly accessible as possible, and anticipating the needs for additional policy changes and advocacy on that front to support working families, such as comprehensive paid leave. We're seeing a clear need to help workers and their families to ensure they can continue to, do basic things like put food on the table, have the ability to stay home from work when they or a loved one are sick, and weather the economic storm that lies ahead. And we believe that the solutions here will call on all of us across philanthropy, government, business, and community and nonprofit groups to act in extraordinary ways. We're bringing an equity lens to this grant-making strategy, understanding that income, race, immigration status, gender and gender identity, sexual orientation, geography, and ability all shape how people are affected by crises and really need to inform the responses. And finally, I just want to circle back to the focus here and say we're also engaged in a lot of conversations about the next phase of recovery across partners in philanthropy and mission-oriented finance to consider structural responses that will require us to stretch outside of our traditional constraints. You know, we're watching an altogether different reality unfold across the for-profit arena in this moment, and particularly in the corporate sector. Take, for example, the cruise industry. Rather than facing immediate foreclosure due to the liabilities of the moment, that industry is drawing down on working capital and lines of credit that have been set up for this purpose long ago. If we are seeing that happen in non-essential industries like that, who are able to tap support from banks, why shouldn't we be able to build a similar robust approach in the nonprofit sector, where we know that the nonprofits are playing an essential role on the front lines? I really want to underscore something Lisa said on this panel, which is that although the ideas of financing nonprofits differently and moving more money quickly from philanthropy to the field have existed for a long time, no more urgent moment than now to act with boldness and creativity. We are in conversation and are sort of anxious to work with partners across mission-aligned investing and philanthropy to think about how we not only protect and work to help the nonprofit sector in this moment, but so that it may have an even stronger tomorrow. We're considering ways that Amalgamated can use our own balance sheet as a tool, and we believe the resources, expertise, and capacity exist within this ecosystem to rise to the challenge and to design and build a set of scaled resources for the nonprofit community to access both for immediate needs and in the long term and in the future.
Thank you, Anna. Thank you for your words, as well as all the speakers from session 2. Before we move to session 3, let me say that unfortunately President John Williams won't be able to join us for this webinar. He was ready to go at 2 o'clock, but technology was not our friend. We tried to troubleshoot at the moment. It took longer than expected. You also noted I spoke for a while. Well, audio things were not happening, and unfortunately he had to take another call. He is telling us that that he appreciates everyone's support and participation in this webinar, and I want to thank him for all the support that he has given to the community development and outreach activities at the bank. Let's move on to session 3. That is titled The Federal Reserve's Role in Building an Equitable Economic Resiliency. We're going to hear from the chair of the board of directors of the Federal Reserve Bank of New York, as well as Executive Vice President for Programs of LISC, Denise Scott, who will have a conversation with 2 of our senior leaders at the New York Fed, Anna Kovner, Vice President of Policy for Financial Stability from the Research and Statistics Group, as well as Kevin Styro, our Executive Vice President and Head of the Supervision Group. So without further ado, Denise, you're on.
Thank you, Adrian. First, let me thank John Williams and David Erickson, and the rest of the senior team and staff at the bank for your leadership and hard work during this crisis. I agree with all of my colleagues that previously spoke and commend them all and all of us for our efforts in support of LMI, MWBE, and not-for-profit communities. And along with all of you, I call out the need for intentionality and commitment for an equitable recovery. Through my leadership at LISC, one of the largest CDFIs in the country, serving over communities in over 40 cities and thousands of rural communities and counties, and as chair of the New York Federal Board, I am lucky to sit in a unique position where I can see the needs of Main Street and the side streets and the power of capital and even Wall Street and certainly the Fed to help us in all of our efforts to really support the vulnerabilities in communities and to recapitalize communities in a way that will preserve their economic and long-term viability. The Board of Governors and Treasury and Congress and as I said, leadership here at the Fed has really done a good job in designing and executing programs to stabilize credit and to put more liquidity in the market. And I know these things are necessary. But as all of you have said, it's not enough. It's not enough for the focus that we need to have that will better reach and serve LMI communities, MWBEs, not-for-profits, the most vulnerable communities among us. Facilities that can make the biggest difference and have the greatest impact in households and businesses. And as many of you have said, the goal is for an equitable recovery to really help to economically stabilize our communities. The Payroll Protection Program, I think we mostly agree that it's a good program, swamped by the immense need, but it calls out the inequity that relates to all of the people who are also very deserving, who are being left out. LISC is one of thousands of CDFIs across the country, and I think Lisa went into great detail on this. Let me just add. Some of us have SBA licenses, some of us are depository institutions. All of us for decades have been primarily focused on serving the same communities that are in most dire need now. The power of our ability to invest and leverage in communities should be greatly enhanced. We need, as was called out, liquidity and access to significantly more resources in order to help restore the financial health of our communities. Let me conclude with these couple of thoughts. One, testing, tracing, more testing. And as Sheena called out, specifically targeted to the communities that are most vulnerable, that right now have had the most negative impact. It's really important that we get a good handle there. And I'll end with a point that was made by Judy Kendi at Enterprise. It's critical to consider the needs of local and state governments. It's my belief, as Judy called out, that these governments are key to our economic recovery. So let's hope that we can really push to restore the revenue that was lost. It's gone. It's not coming back. There has to be a plan to put revenue in the hands of local and state governments. So with that, I'm going to turn the mic over. I'm thanking you all again for all of our efforts and looking forward to working with all of you. I'm going to turn the mic over to Anna Kovner, who is going to talk about some of the facilities that the Federal Reserve has announced to support the U.S. economy. And then Kevin Styro will take over the mic from her to talk about what the Fed is doing to support the economy and to protect consumers and small businesses through supervisory and regulatory actions. Okay, Anna, I'm turning the mic to you.
Thank you, Denise. And thanks to all of you for the work that you're doing. I'll start by saying what we already know, that this situation is unprecedented and it's affecting millions of people around the world in so many different and often devastating ways, including economically. I'm going to talk today about some of the facilities that the Federal Reserve has announced to support the U.S. economy. As I share with you some insights about how we are leveraging capital allocated by Congress to the U.S. Treasury to help Americans, note I'm speaking for myself. These views do not necessarily reflect those of the Federal Reserve System or the New York Fed, and in compliance with FOMC policy during blackout periods in advance of the FOMC meeting, I won't be expressing views or analysis about monetary policy related issues. In the short time that I have today, I don't have the time to go through each of the Federal Reserve facilities, but I want to begin somewhere counterintuitive with facilities that may seem distant from all of you and from Main Street. Borrowing prices across the financial system are determined by market prices for U.S. Treasuries, for corporate bonds, and the funding costs of banks. And so ensuring that those markets are functioning is a critical first step in ensuring access to finance at reasonable prices for small businesses and consumers. Facilities we've established for primary dealers, commercial paper, and the corporate credit facilities are all helping to achieve that goal. That said, let me share an overview of 4 important facilities where the Fed is working more directly to help households and employers of all sizes and to try to bolster the ability of state and local government to deliver critical services. First, the Municipal Liquidity Facility is designed to help provide states, cities, and counties with funding to provide essential public services. The municipal securities market has been strained as investors have been concerned about funding the necessary response to the pandemic. At the same time, we've seen states, cities, and counties facing severe cash needs from increases in their spending related directly to the pandemic and to the fall and delay in their tax revenues. This facility will help increase funding available to eligible localities through notes that rely on proceeds in anticipation of tax revenues. These proceeds can be used directly as well as to support smaller political subdivisions. And this facility provides a form of bridge financing so that local governments can fund programs even while they maintain the ability to delay taxes. Second, the Main Street Lending Program enhances support for small and mid-sized businesses that were in good financial standing before the crisis. In March and April, Federal Reserve staff conducted a series of outreach calls to 48 banking organizations and 20 mid-sized businesses so we can continue to understand their views on proposed structures for a Main Street business lending program. And what we've heard and what we continue to hear is going to be instrumental so that we can continue to shape our facilities to meet the needs of American business. Third, the Term Asset-Backed Securities Loan Facility, or TALF, supports the issuance of new securities that are backed by student loans, auto loans, credit card loans, small business loans, and other debt. Support for these asset-backed markets ensures that new loans can be originated and sold, thus reducing borrowing costs and allowing people to finance cars, to access credit through credit cards, to issue commercial mortgages, and to fund purchases of equipment. Finally, the Paycheck Protection Program Liquidity Facility, which has been mentioned several times in this program, bolsters the effectiveness of the Small Business Administration's Paycheck Protection Program by supplying liquidity to participating financial institutions through 2-year loans backed by PPP loans as collateral. This program exemplifies our mission to help facilitate access to U.S. government programs by ensuring that liquidity constraints do not stop the widest possible mix of financial institutions from extending these programs to borrowers. And I assure you that we have heard from the community, CDFIs and others, about the interest in participating in this program. Considering the speed and the scale of damage caused by the virus outbreak and measures to contain it, we're making all efforts to implement these facilities as quickly as possible. At the same time, we're listening to the communities we serve, hearing how difficult the economic shutdown has been for entrepreneurs and households, but especially for small businesses, those that are outside of the banking system, and communities that may be already underserved. The Fed does not act alone in this. fiscal policy is a key partner in providing for the public health response and in transferring income to those most affected by the outbreak. Congress and the U.S. Treasury are key partners, mandating the facilities I described, supplying the financial support necessary for the scale of the facilities we are operating, and it's only with this fiscal support that we can ensure the success of key programs like the PPP. We recognize the differential impact of this public health crisis on many of our communities and the need to ensure that we offer as broad support as possible, and will continue to work tirelessly to support the U.S. economy and the communities that we serve. I'll turn the mic over to Kevin Styro, who can talk about supervision and regulation.
Good afternoon, everyone, and thank you for your critical work and for participating in this important forum this afternoon. The COVID-19 pandemic is impacting all of us, first and foremost from a health perspective, but clearly in terms of social and economic impacts. And has been discussed extensively today, this impact has fallen heavily on low-income and minority communities across all three dimensions. Today I'll speak about what the Federal Reserve is doing to support the economy and to protect consumers and small businesses through our supervisory actions. I'll highlight, however, that these actions are focused on supervised banks and do not address the significant challenges faced by those households and businesses outside of the traditional banking sector and served by socially responsible capital providers such as CDFIs, nonprofits, foundations, and other impact investors. Broadly speaking, the fundamental purpose of banking is to provide financial services such as credit provision, payments, and deposit taking to support sustained economic growth. This is true in normal times and even more true in the current environment. And the Fed has taken a number of steps designed to limit the potential for financial channels to amplify the initial economic shock created by the COVID-19 virus. Beginning with supervision, the federal banking agencies, in consultation with state financial regulators, are actively encouraging financial institutions to work with their borrowers in a safe and sound manner. The agencies view prudent loan modification programs as positive and proactive actions that can help both borrowers and lenders. And this approach is consistent with the agency's long-standing practice of encouraging financial institutions to assist borrowers in times of natural disasters and other extreme events. The Fed has also provided information on how we are adjusting our supervisory approach. This includes, for example, monitoring and outreach to help banks of all sizes understand the current challenges and risks. It includes a temporary reduction in exam activities, particularly for the smallest and lowest risk institutions. And we are providing additional time to resolve non-critical supervisory findings. These actions should help financial institutions deploy their resources as efficiently as possible and continue to support their customers and local economies in a prudent and fair manner. On the regulatory side, the Fed has taken a number of steps to encourage banks to use their balance sheets to support borrowers. For community banks, for example, the federal banking agencies are implementing the part of the CARES Act to lower the community bank leverage ratio. In terms of liquidity, the Fed has actively encouraged banks to use the discount window to help meet the demand for credit from households and borrowers. To make this more attractive, the Fed has lowered the borrowing rate, extended the term of these loans, and actively signaled support for discount window use. And as mentioned previously, the Fed has implemented the Paycheck Protection Program liquidity facility with a goal of extending credit to financial institutions that make PPP loans. In terms of eligibility, the Federal Reserve is working to expand eligibility for PPP lenders that are not depository institutions. The Fed has also emphasized the importance of consumer protection during this period. The federal banking agencies, for example, made clear that lenders and servicers should adhere to consumer protection requirements, including fair lending laws, and provide the opportunity for all borrowers to benefit from these arrangements. The federal banking agencies have also confirmed that in the context of the Community Reinvestment Act, they will favorably consider retail banking services and retail lending activities in a financial institutions assessment area that are responsive to the needs of low and moderate income individuals, small businesses, and small farms affected by COVID-19, consistent with safe and sound banking practices. This includes, for example, waiving certain fees, easing restrictions on check cashing, expanding the availability of credit, providing alternative service options, and offering alternative payment options. In terms of supervision, the Fed has prioritized monitoring to evaluate the impact of consumers to ensure that banks work in good faith with consumers, apply fair treatment, and mitigate consumer harm. Taken together, these steps demonstrate the Fed's strong commitment to help the U.S. banking system support the U.S. economy and protect consumers during the COVID-19 pandemic. We are aware, however, that many low-income and minority communities remain severely impacted. The regional partnership between the New York Fed and socially responsible providers of capital continues to inform our understanding of the need for access to credit for these critical small businesses. We will continue to work with all of you to ensure that the financial system acts as a source of strength to support all sectors of the U.S. economy. Thank you.
I'm not sure if we have Denise on the line right now, Kevin.
Okay, here I am. My technology challenges. Hope I can get the video. And so I really just want to thank everyone. This has been, I think, a great event. There's a lot for us to continue to talk about. And certainly we heard the Fed is listening. I think that's the main thing. And we're going to try to figure out how we can get back to a focus as we hang up, continue our focus on ways to make recovery equitable. All of the different recommendations that we just heard are recommendations that I think we'll be taking under consideration. So a lot more to continue to talk to you about, a lot more to get from you in terms of your ideas and exactly how we can advance the cause. But on behalf of the team at the Fed, I am just so proud of all of us, right? You guys rock, and communities are just so, they're just in a good place because of all of the leadership that all of you do. So thank you.
Thank you, Denise. And just to wrap up, because we are right out of time, I want to thank all the speakers today for joining us, as well as all the participants who joined this webinar. 3 quick things. As I said, the video will be posted in our website, so your organization or others can look at it. It will happen in the next couple of days. We will send you a survey by email, and we will truly appreciate if you can respond to those questions. As Denise just mentioned, we are listening, and that information, those opinions are very important for us. So please send back those surveys. And finally, we are taking notes of all this information, and we want to highlight the takeaways that we're also planning to post within the next week. Thank you, everyone, for joining us, and see you next time. Stay safe and healthy.